Hello. Hi, Pantelis. Thank you very much for joining in. Today, I'm going to talk about the elite, the 5% elite, how to get into the elite and how you can stay in the elite based on my experience and what I've learned about the markets. I want to thank Adinda and Vicky for organizing this webinar. I'm Giuseppe Basile. I will be your host today. So let's start. Let's get into it because, as usual, my webinars are very highly packed, and this is going to be the agenda. So I'm going to introduce who I believe is the elite, and also, who's the remaining 95%. Very important. And whether it's 95%, it's more or less. And I'll show you that actually the 95%, the rest of traders, especially in the retail space, are not consistent in the medium long term. I'll then review a few principles, truths, and best practices that the elite actually respects and practice, and we'll then look at some of the mistakes in some of the areas. Unfortunately, I will not be able to cover all the areas I had in mind, but we will definitely see the most important ones and show how you can actually correct those mistakes, what you can do in order to actually play the market the same way as the elite plays the market. And then we will have a Q&A. Hopefully we'll have time for that. As you know, risk for me is very, very important. I'll show charts and I'll do considerations on current markets as well. Risk is very important. When the money is gone, the game is over. So if you are watching the video, this webinar now, please stop here the recording and have a look at the slide. Just some background information about myself. I won't go into this in detail. I'll just say that I'll start in 2001. I started with a few mentors, and that's a very important thing to do, especially if you are starting. I also launched FibStalkerTraining.com in July 2014, and there I keep enrolling in for my FibStalker Methods coaching program, where I teach how to time the markets, how to identify levels that are highly watched by algorithms, as well as I teach how to create a robust trading system and how to install and confidently install that trading system and make sure that you trade again and again. I also have a blog and I have a free weekly newsletter there, and I send a market review every Sunday. So let's get into it. So who is the elite 5%? Mainly professional traders, hedge funds. In the Forex market, of course, major commercial banks and global institutions constitute the bulk of the market, probably 96%, 95 to 96% of the market. And high frequency trading and algos boutiques, these are small shops that actually run different classes and types of algorithms. High frequency trading would be one of this. I actually have a webinar that you can find in my contribution area on FX Street if you want to learn more about HFT and what it means for our trading. And boutiques who actually run algorithms, again, different classes, which try to get advantage of several type of situation. So the elite makes money in different ways, not only against professional retail traders. That's probably a small part of it. If you think that retail customer speculators are only 3.5% of the total volume, daily volume, which is around probably 180 billions. And I'm not talking here only about speculation and retail trading. There is also retail customers. So This could be small businesses or you buying a product or service through PayPal. So you have to make sure that you have the funds. For example, if you buy in dollars and you live in the euro area, you will need to have an intermediator actually changes those euros into dollars before you can buy. Elite also makes money against retirement investments. For example, equity thinks of high-frequency trading, which takes advantage of the big orders coming from equity funds, just to make an example. And of course, the majority comes from serving the international trading and the international commercial exchanges, sourcing currency for a commission. So what are the things that the elite can do? And there's no way we can do them, right? But it's good to know that they are there. I mean, there are several ways, as they say, to skin the cat. Professional traders in the elite can take advantage of other ways the elite itself makes money with. Now, some examples of things that they do we cannot do is, for example, run high-frequency trading algorithms to take advantage of funds' large order executions. If an equity fund has to buy 10 million worth of stock, that will put into the system, into the market, an iceberg order, and there can be high-frequency trading algorithms that are capable of recognizing there is a very large order that is pending there, and they will try to take advantage of it. This kind of behavior can be seen in Forex as well. Earning a commission to source currency for international commercial trading, I mentioned that already. So that's a commission-based type of business, and banks will do this. There are major banks that make the bulk of their money in this way, and they will try to offset risk internally or onto third parties. And this concept of offsetting risk is very, very important, and that's something that we can work as well as retail traders. There can be specialized high-frequency trading algorithms like the latest version of Stealth and Sniper. Stealth is a very successful high-frequency trading algorithm created by Deutsche Bank. And now what is interesting is that these algorithms can actually now source liquidity not only from human traders, but also from other high-frequency trading algorithms. And it could be a very interesting discussion of how we as humans deal with complexity and actually look at the complicated problems like that of sourcing liquidity by reducing it in a small number of variables. And then finding rich relationships within these variables. That's not the way high-frequency trading works and machine works, because they can actually take a complicated space and break it up in many, many variables and then try to find relationship between those variables. I mean, this is a very long discussion. I mean, I'm really a lot into high-frequency trading. High-frequency trading, I read here, it's really a scam where profits are skimmed from low-level random noise in the market. Well, modern low-level random noise, I would say, clear footprints of participation by larger funds and participants in the market to actually have to take larger positions. So in that way, they act as a liquidity provider. But I agree with you that it is a scam, and is supposed to be. It is justified. HFT is justified sometimes as creating liquidity, but in reality is only in the majority of the cases, extracting liquidity, and especially under stress conditions in the market, high-frequency trading disappears. So removing also the liquidity. I have dedicated a full webinar on high-frequency trading last year, so if you want, you can review that. The elite also takes advantage of the return to previous liquidity basis. Sometimes there are rallies and which are created by competition among major banks when price starts moving out of supply. Out of liquidity basis, and that's a behavior that actually can be exploited as well. And of course, algo arbitraging small differences in pricing correlated instruments. There are things that, and these are much more interesting, that actually the elite can do and we can leverage too, and that's important. The first observation here is that the elite does not use traditional technical analysis. Why should we, right? And the way things that they do, and we can do as well, to source liquidity at obvious levels and areas. And this is more related to how the elite behaves and how they exploit those levels that are related to what we call the self-fulfilling prophecies. I'll make a quick example later on. In relation to moving average. Now, we know that the elite runs specific classes of algorithms on the large time frames, and they are strong enough in my beliefs, and this shows in my charts, and I'll give some examples if you look at my work as well. You know that in absence of news, geopolitical events, and central bank government intervention, some algorithms literally, in my belief. Yes, if you can see the chart, please. And at some point back in October, and actually before, we saw a couple of weeks. We saw a move lower here. We saw this move lower here. In reality, we saw the first few weeks of when you have these levels. You can actually time the sequence of measure move into these levels and basically confirm the participation of algorithms at this level. So that's exactly what I did, and I gave this level in with 3 weeks in advance. And at the same time, you could look at the daily time frame or the daily or the 2-hour time frame. So let's focus on the daily here. On the daily, you can study the sequence of measure move lower. So when you have a level here, which is a valid level where participation from algorithms could actually take place, of course on the upside, because we're still on a cycle, an up cycle here in the SP 500. What you would do then is study the sequence of measure move as the market gets into that level. And in this case, we would see at 1960 here with first and second target. And then after that, one way to model the counter trend algorithms on this time frame is to trace the next measure move. As you can see here, when market gets into this level, the next 50% of this sequence here, we would expect on the daily time frame a continuation lower. And in fact, that's what happened, because at the very beginning, after the market tests this level, and that's the 1859 on this chart, initially goes lower, but then it hits that larger 50% level. Okay, so it hits a level where we anticipate participation from algorithms on the upside. So as you can see, there is a sequence of measure move here, which is pushing price lower, and there is potential participation higher. Who wins is only the market can tell us. The point is that as soon as this level is placed on the upside, there was an indication that The longs here coming from the weekly level were stronger than the shorts that were pushing this price lower. Okay, so going back to the presentation, then that's something that when I say effectively test participation at certain predetermined areas, that's what the elite does. Actually, the elite runs the algorithms, but there are ways to identify those levels in advance and then time them. The elite is also very concerned about risk, and they try to actually pass on risk as much as possible, and that's something that you should do as well. And in reality, the majority of traders, retail traders, especially the starting traders, they're very annoyed, quite annoyed with the risk management, which is the most important thing on the other hand. And they do exactly the opposite of what the elite does. Professional traders try to, get very high reward to risk ratios, risking very small amount of money. On the other hand, most traders, what they do, they take large risk. I have evidence and read a lot of articles and speak very often with traders that take large risk, like 5%. And they take this large risk on 1-to-1 reward to risk ratios, which to me does make no sense, right? Because in reality, you want to minimize your risk at all times, and you want to work on your trading system in order to increase the reward to risk ratios to something way more than 1-to-1, maybe 5, 10, 14, and 15, and I'll show you some examples. And you want to use that as an opportunity to reduce your risk. Okay, so to me, having risking 5% or even 2%, it's kind of an excuse for saying I don't have a good trading system, so my reward to risk are very limited. So if I want to make money in the market, I have to risk more. I have a question here from Pantelis who says, what's the probability percentage of this reaction caused by the larger time frame? 50%. Well, in some of these traces, like the one that I gave you before, which is an aggressive extensions, it can be very, very high. It can be 80%, 90%. Of course, we never blindly buy that 50% level. We always test that participation with very similarly to that example that I showed you before. In fact, that example is an application of my fib stalking timing technique, which is a proprietary technique. So the elite also respects the market principles and truths and market psychology as well, and that's what you should do as well, and we can do this as well. You're very welcome, Pantelis. Thank you. So let's look at some example now of one of the points I mentioned here, which is let's see if I can annotate. But basically, it's the first point: sourcing liquidity at obvious levels. So let's see how some example of how the elite sources liquidity at obvious level. And here I'm doing a very simple example in which my obvious level is 20-day moving average, which is watched by a lot of people. And as you can see, here I have an extension and I have a potential 50% level of participation, very similar to what I've showed you before. I just use rules to identify these levels. And what we see here is that the market initially bounces at this 20-day moving average. However, the bounce does not last enough or a lot, because we know that this is only a level where a lot of people expect participation or a bounce, and that level is used by the elite to source liquidity there. But it's not until price gets into that valid 50% level retracement that the market can actually continue higher. Okay, so that's something that you have to keep in mind, and something that it's very, very important. So let me see. Similar examples you can see here. There is participation at some levels, but then sometimes those levels are not respected all the times, and in fact, there are much more important levels that are respected, and there is a reason why they are respected. This is an extension long with a valid 50% level there. And, we can go on and show again multiple examples of this. So, of course, as I mentioned, the risk management is number one. The elite really understands and practice risk management. You should do that as well. I have here, I'm not going into details into the formulas to calculate the position size to guarantee that you risk a fixed percentage of your account. There are also ways to leverage money management to supercharge your profits. If you're interested in this, I have a few webinars that I recorded last year. They're all free, the majority of them. There is one which is related to market psychology, which is a premium one in June 19, but have a look at them. And they give quite a lot of insights about how to manage risk and how to use money management to reach your objectives in trading. So who is this remaining 95%? Let's get into it finally, okay? And let's clarify this once and forever. It's really 95%, and this is, the crowd of retail traders, beginner, dreamers, gamblers, traders with experience but not consistent. And I was in the past, was part of this group as well. I'm talking here about the 95% who do not make money consistently. They might make money for a limited period of time, 3 months, 4 months, 6 months, within a period of time, but then they revert to their average behavior, and which comes with average returns as well. So it is not doubts that it's 95% and not less of them. And I'll show that to you. There is a report which is published by Forex magnates here, and this is fourth quarter of 2013. And the major brokers report failure between 55% and 73% of the cases, which means 45% of success and up to 27% of success. I think the numbers are much lower, and I'll answer that question later on. Let me complete this. The actual percentage is much lower. These numbers are reported on quarterly basis, and they not consider very often the survival bias. So the people who are actually the accounts which are reported here, are these the same accounts? Do these accounts also take into consideration the closed accounts, for example? Because those people are among the 95% of people who did not have success in the market. Inactive accounts, here we see 96,000 accounts plus, and there may be another 100,000 accounts that are inactive. So if we consider the inactive accounts, these figures will be, right away be slashed in half, going from 26 to 45, back down to 13 to 22%. And now, we also have to consider that lack of continuity, because here in this quarter there may be an account that is reported as successful, but last quarter maybe was not successful, was not making money, and the next quarter will not make money. So when you consider all this, you'll see that the actual, when you consider all these adjustments, you'll see that the actual number will be close to 95%. There is more evidence. If you look at the demo contest in 2014, 444 out of 3,253 accounts which is the 13% made more than 0% with a drawdown on 90%. Now remember, this is demo account, okay? It's a demo account, which means that when you manage real money and you have a drawdown of 90%, do you really believe that you would continue trading? Also, you know, when you actually trade real money, then you'll have much more pressure, and there'll be things that you will not be able to do, and you can only do on the demo on a demo account. So this 30% again is much lower. But let's look at more evidence. In 2008, the China banking regulatory body saying that 18 to 90% of players had lost money. There's a nice report from the Taiwanese Stock Exchange, 2011, and they say that only 2% of traders made money consistently, and this was 1,000 out of 360,000 individuals that were able to make money consistently. Again, FSC 2010 demo trading consensus, again, demo in 2 months, 90% of losers. So this is the proof that it's really 90%, 90 to 95%, it's not less than that. I have a question from FX Bookie here. Is liquidity equals support and resistance? Well, what is support and resistance? Support and resistance is just a line on a chart. What's the meaning of that line? To me, it does not have a lot of meaning. So liquidity are more, areas where we can see participation either from algorithms or from banks, from actually entities and participants who can actually move the market. So the elite also will do. Actually, they will manage risk properly and try to pass it as much as possible and as quickly as possible and create a risk-free transaction. We call them risk-free trades, and you can do that as well. Also, they have multiple risk management mechanisms in place. I call them parachutes, and I have I always talk about 3 different mechanisms, different parachutes. The first one is absolutely important, psychologically, it's to accept risk. If we do not accept risk, and it happened to me in the past to take a position, take a level of risk that I was not accepting, which means that if you don't accept risk, you will not be willing to act if the market goes against you. And this is psychological, of course. The reason why people do not accept risk is that they only think of the upside. They only think about gains. They never think about the fact that they can lose money. Okay, so the second parachute, the risk parachute, is to pick a small risk, 1% or lower, and people will laugh at me. Some people will laugh at you as well when you pick a small risk. But I mentioned that again. So people believe that they can risk 5% just because they tag their account as risky money, as money that they can lose. There is not such a silly thing as money that can be lost. This is a silly concept, okay? No money should ever be lost in trading. Trading is a business, and you have to manage your risk. So what our words and thoughts are important. The way we tag that money is very, very important. To me, as I mentioned before, adopting a high risk always means that something is being hidden here, and probably an high risk is hiding a poor trading edge. It should be the opposite. Have a very good trading edge and reduce risk as much as possible. I always say risk management is job number 1, so you should do the same. Pantelis is mentioning a PPC, protect precious capital there, and that's a very important point. Thanks for mentioning that, Pantelis.
So number 3 is to implement a method that gives you a fair risk trade, and there are ways of doing that as well. And ideally, just very quickly here, let me give you this idea. Ideally, you want to trade low risk ideas. Now, if you are able to identify levels where there is a potential participation of algorithms, okay, and you are able to time that participation and understand when that participation, which are the levels that confirm that the participation on the downside from the smaller time frame in this counter trend move is weaker than the participation on the long time in this example. This is a long, but the same concept applies for a short. If you have a mechanism that allows you to identify levels where this strength higher is confirmed, typically what happens is that even if the market retraces, the market will actually give you at least a fair risk trade, which means that will give you at least a move in the direction of the trade, in this case long, so that the distance between your confirmation level and your stop, which could be below low here, and price will move at least one distance, the same distance from the point of entry and the stop, so that you can actually, by reducing your position at this level, you can actually have a fair risk trade. So take half off and you will have a fair risk trade. The question here, which time frame are you talking about? I'm talking about all the time frames, FX Bookie, because I'm talking about high liquid markets here, and the major forex, for example, are in that category. In high volume markets, algorithms are present on all time frames, and I'll make some examples for you here. We don't have a lot of time, so I'd like to make maybe show an example here and tell you what I mean. What I mean here, participation form short covering. Well, participation as I intended here is to take a position. Now, taking a position typically on a weekly, daily time frame, it's what some classes of algorithms do. And I'm going to show you now an example on the US dollar versus Japanese yen, a recent example. So, of course, that participation, which is a buy here, can be used by the algorithms of professionals which actually ride this move lower to close their position as well, right? They have shorts, they need supply. They need demand, so they can close their position. So, FX Boogie, let me make an example and show you what a 50% level. In SP 500, a 50% level is the level that I showed you before. On the weekly time frame is this level here. This is a level of potential participation that has to be confirmed. And the way we confirmed it was in the daily, study the opposite sequence of measure move lower here. And when that measure move has failed, exactly as I showed you in the example, when that move fails, gives us a confirmation that the guys who are here, who are buying on the larger time frame, actually are more powerful of the guys who are selling into the counter trend move into that 50% level, okay? There are rules and ways to model the algorithms, and those rules provide you with 50% levels that you can time. Now, let me give you an example on the US dollar versus Japanese yen here, and so before we get into the detail, let me show you how in time I've modeled this market, and you will find last year, August the 1st, You can search on FS Street an article in which I mentioned these two targets, 102 and 115, well in advance. I mentioned those here, but I had these trades back into in my videos, for months, for weeks here. So what we have here, we had a level that was identified well before the fact here. I identified this level when the market showed this move here. Show this first. Sorry, let me show this to you. So once we saw this first red bar here, I kept tracing this measure move, okay? And at some point the market did not print any higher highs here. So, and the market just started moving into that level. Eventually tested that 94 level there. And we could study the sequence of measure move, and when that sequence failed eventually, there was an indication to enter long with stop below lows. Okay. Now, the market eventually took a lot of time, took 18 months to get into the first and second target here, but eventually that's what happened. Now, the weekly time frame is currently neutral, and it's waiting for this market to retrace, if this market retraces into the 11280. Once there, we are in a very similar situation as we were back in June 2013. Okay. Of course, as I mentioned, measure move on all time frames, and there is a sequence of measure moves also on the daily time frame. And that's what has been maintaining this price higher. Let me show to you that measure move, okay? That sequence of measure move. And so, again, I mentioned these measure moves well before the fact. And there was this participation at 105. This could be identified with almost 2 weeks in advance. And when the market went into the level, the market went into the first and second target and well above the second target. So by modeling this market in extension, that's the reason why we got participation twice at those levels. Okay. Now, so these are the 50% levels, and when you have those levels well in advance, in this case we had that with 6 days in advance, you have plenty of time to study the sequence of measure move into those levels. Okay, and these traces and these levels which model how algorithms affect price can be traced on all time frames. And so let me show you an example of, timing our second test into this level here, okay? So I'm going to show you how you could actually time that on different time frames. Actually, you could time that on the 15 minutes time frame, and you could actually, let me remove some of this. So, and when the market gets into those levels before and as it gets into those levels, always print sequences of measure moves. If you're able to model those sequences of measure moves, when they see those sequences break, that's when you know with quite a good percentage of success, which is between 80% to 90%, that the participation from the longer side, longer time frame, it's stronger than the participation on the shorter time frame. For example, let's look at this sequence here. We had the market moving lower here, then retraces into this 50%, 117.09, and then eventually going and hitting that first target. These levels are not there. I always use the same levels. These are the same levels that are watched by algorithms as well. And once price gets into those levels, of course, market can continue lower, right? If the sequence keeps to be respected. But more often than not, what will happen is that the larger time frame will always win. The difficult part is when you use traditional technical analysis that does not leverage algorithms. You don't know where these levels that confirm are. So once you know how to trace these sequences, and this is a simple example, but it's all of this is deterministic anyway, because algorithms follow rules. So it's a cause effect kind of behavior. So in this case, if you enter, even if you enter with a breakout here and you put a stop below lows, you have a dollar risk of a pip risk, which is, as you can see, very soon is actually equaled here by price. So if you risk 1% here and you exit half of your position at this level here, you carry now zero risk, because if the market retraces against you and stops you out, you are carrying zero risk, and that's the concept of free risk trade. Okay, and that's something that the elite does, and you should do as well. So if the measure 50% move of the next larger time frame. Okay, so sorry, that was an answer from Pantelis. Thanks, Pantelis. Do you consider fundamentals? I do not consider fundamentals because I believe, and the proof is on the charts, that algorithms will always be actually positioned in advance and compatibly with fundamentals. A proof, it's one of the proofs, if you wish, is here in the US dollar versus Japanese yen. The market here and algorithms knew or anticipated that the Japanese central bank could actually start QE2, JQE2, and that's what happened. So if we follow algorithms, more often than not, we will find ourselves positioned in the direction of the trade. Okay, so there could be reasons to follow fundamentals. The point is that fundamentals give only you a general direction of what should happen. Price is the final, price is king. Price is what decides what actually happens. So to me, it would be very confusing to integrate fundamental analysis into my consideration. Now, that said, of course, working on the very large time frames, you can actually integrate qualitatively the indication of fundamental analysis given to you. What was that drawing? So the drawing was, were we talking about the 15 minutes here? So if you refer to this, that drawing was the sequence of measured moves that model how algorithms are pushing this price lower. Okay, algorithms are pushing this price lower. When that sequence of measured move fails at that level that I showed you before, that's an indication that the sequence of measured move has failed, and it's an indication that the participation from the larger time frame has probability to keep pushing this price higher. And that's what we saw on the daily time frame as well. Of course, the way price reacts to logical levels where algorithms should be working or should be active also tells us of the further development of a trend. So let's reason on this latest example here. Sorry, I was just reading the chat here. Give me just 1 second. Yeah, go ahead, Pantelis, no problems. So, so what we see here, we see a potential participation on the long side from algorithms, and it's evident there is participation there, because every time price gets into this 50% level, which is a simple 50% level from lows to the swing highs that we observed, and when you are, when you see this high and then you see this first reaction lower, you can trace that, and you can see that again price test 1, 2, 3, 4, 5, 6 a number of times, and then eventually breaks it. So what that market is telling me is that here there were bulls willing to push this price higher. At some point that level fails. Okay, now that level failing means that bulls are a little bit undecided here. They were convinced, and now they're not convinced anymore. And what happens is that then the daily, it's not supporting this price higher. And you might ask, but this price is going higher, so who's pushing this price higher? And that's the whole point of it. The smaller time frame is pushing this price higher, which means 4 hours, 15 minutes. But as soon as there is no support from the daily, as soon as the inner sequence of measure move here fails, this market will need to retrace. Okay, and this is I call this the price discovery. So by looking at how price behaves in relation to traces that model algorithms, we can also know the quality of a trend. And let me now show you this trend higher in the smaller time frame, how we model it. Okay, so when we get, for example, into the 240 minutes, this is where we are. So the highs to highs here, we see that there is at some point, as price gets into this below the 61.8% level, it shows that the daily time frame is not willing to push this price higher anymore. And now, how do we model this sequence of measure move higher? There is clear participation here. If we look at the pace of this move here, and we compare to this pace here, you can clearly see that there is participation. And we also know that this is a rally, which is actually implied by banks actually bidding higher and higher and higher, and they have to do that. And it's the way the game is being played by the major banks, and there is a whole other chapter that can be opened on this. But it's not really important what it is that produces those effects. What is important is that we have a retrace here, and how do we capture that retrace? That's the most important thing. And I don't have a lot of time here, so I will need to close soon. So I'll just show this example, and then probably I will need to finish this this presentation. But we have an extension here, and there are ways to identify before the retracement this anchor here. And when price get into the level, when it gets into this level, 11840, price gets into the first and second target here. So there is a sequence here being respected. The point is that we know that this setup is not supported by the daily. So price gets into the first and second target, and then the next measure move actually fails. And when it fails, it gives an indication that now this price has to retrace all the way halfway back, at least into the 50% level. And that's the way, these are rules that model how algorithms work. And in fact, we are getting there now. This is not live data here, but we are getting there. So once you saw this level broken on the downside, you could actually, take a position here with a stop to highs. It's not a big, it's not, I mean, it's the 1 to 2 reward to risk ratio. That's not what typically I look for. I look for 5, 10. It can give even more if you time on the 15 minutes and 1 minute. So, we can use these rules that we use to model algorithms to also know when things do not go well. Now, I have other questions here. Can we have part 2 in the future? I will definitely do part 2 probably in my next premium webinar on FX Street, because there's so much to say about this. And of course, I could only scratch the surface here. And when you draw, as there is another question there, when you draw your new fib at minus 23.6% or a minus 61.8%. These two targets, type of targets, also model two different ways the market moves. Whether we get to the first and second target changes the way we trace these measured moves. Okay, so market getting into the second target indicates that the market is extended. We need different rules to model actually a market that is moving with a different gear. So I want to have more time. I only scratched the surface here. There would be a lot to say, and there are different areas. I call them the 7 pillars of trading: methods, timing, technique, risk management, money management. That is really what we use to reach our objectives, not making our risk higher. And also the psychology of the market, the psychology of the trader. And there was a discussion also here. As you can see, there's so much to say. I will actually continue with a series of webinars here on the how to match the elite. And I hope this was interesting. If there are any other questions, otherwise, as soon as Adinda will stop me, I will need to stop. But there's so much to say about this. If you have any questions, please write them down. Otherwise, I'll just, for now, close it here. Yeah, hey. Okay. So that's it then. Thank you very much, and talk to you soon. Bye-bye now.